Okay, I can see quite a few people joining. Thanks everyone for joining on Monday morning. Yeah, so today so Stephen Lee here from Odin Mortgage and Tax. So I look after our mortgage division, and I have my colleague Pau Lam from our Odin Tax. So it's our pleasure to take you through what's happening in the Australian property market, as well as some key learnings and tips when you're considering applying for a home loan as an expat. And Pau will take us through some tax implications and considerations and a piece of advice as we get closer to the deadline of the tax return due date in Australia. So how we're going to run the show today is, so we'll go through some contents that we have. And then thankfully we had a lot of great questions that we received through registration. So as much as the time allows, we'll go through as many questions as we can. And in case we missed out any questions, we'll address them after the webinar. If you have any questions during the event, please use the Q&A section in the Zoom meeting. So in that way, for any questions that we could answer, we'll just address them live. So on that note, let's kick off. So I'll go first, but just to start with some general information that we want to make sure that the information that we're providing, it's not a personal advice to your circumstances. There's a general information where if you would like to obtain a personal advice, please come and talk to specialists like myself and Pau. So on that note, I'll kick off. Pau, can you give me a thumbs up if you can see my screen? Sweet. Yeah, so let's kick off. So firstly, for those who don't know who Odin is, so I wanted to just take you through who Odin Mortgage is. So Odin Mortgage, with the Australian mortgage brokerage company serving expats and overseas investors looking to buy properties in Australia or review their existing mortgages and attack and an optimization opportunity. So our main services are home buying, whether you're buying a first home in Australia or looking to build out your investment portfolio or even a future family home, we can come in and help you to understand the process and help you all the way through to settlement and beyond. And then refinance. So the Australian home loan landscape has been quite dynamic with the relatively high interest rates for some time, where we're now seeing that landscape is shifting with some changes to the interest rates and the product offering. So there's some opportunities for us to consider refinancing your home loan if you already own a property and a mortgage. And we have access to 20 plus lender options in Australia, as well as some international banks in Asian markets to help you access the best available home loan in market. And also for those who are looking to explore what you may be able to do with surplus equity that you may have in the property. And that's where we can actually come in to help you understand how much equity that you may be able to access from your property by borrowing a bit more against your current property for your next investment. So in terms of why us, why Odin? So there are three key propositions that we have for the communities of expats and overseas investors. So number one is our expertise. So we specialize in lending to expats and overseas investors who are living and working outside Australia, earning foreign currency income. And I guess our strength is translating that overseas or expat living circumstances into the banks and lenders' language. So that way we increases the chance of you to get the home loan approval, as well as get the optimal lending in your best interest. And secondly is around experience. So as I touched base, we have access to 20 plus lenders, including major banks in Australia, so-called Big Four, as well as regional banks who have a bit more flexible policies for expats, and even non-bank lenders who have designated products for expats and overseas investors. And also for some Asian markets or European markets, we may be able to help you access some international banks as well. And then finally, our service is end to end. So our service continues until the life cycle of your property. So what that means is that unlike typical financial services or mortgage brokering company, so our service starts from the time when you're actually when you start considering to purchase a property, all the way until to make a purchase, settle, and even beyond. And what that means is that even after settling on your home loan or purchase, we'll help you to continue to monitor your home loan product to make sure that they're the best in the market, and also keep you up to date with some better offers or other options that are available to you. And our service will continue until you either sell the property and pay off the mortgage, or you pay off the mortgage. So let's take a look at what's happening in the Australian property market. So I'll keep it quite generic and just pull out the headline numbers. So this chart and the numbers, it shows the growth of the Australian property market across the capital cities as well as regional areas for the last 10 years. But I'd like to highlight the last 12 months. So far, so we have just over $11 trillion worth of residential real estate in Australia, which is more than half of the total Australians' household wealth. And there are about $2.3 trillion of mortgages that are outstanding. And then what's quite interesting and exciting for the market participants is that although there has been a lot of news and information rumors around the economic downturn, and for the last 12 months, Australian property has remained resilient. So across both capital cities and regional cities, that the market has been delivering just under 7% growth, and which is mainly driven by Perth, Adelaide, and Brisbane. As you can see on the chart, that Perth has been a hotspot for a lot of not only onshore Australian home buyers, but amongst the expats and the overseas investors, where it's been delivering 24% growth year on year. And then let's take a look at what's happening in the home loan rates. So as interest rates is the hot topic in the property market in Australia. So now that Reserve Bank of Australia has kept their interest rates on the peak for the last 12 months at 4.35%, the average variable rate home loan for investors are now sitting at 6.5%, as well as the fixed rates are now sitting between 6.5 to 7.45%. So what this chart and data indicates is that if you already have a property and a mortgage, and your current interest rate is above the rates that you'll see on the slides, there's an opportunity for us to potentially save you the home loan expenses, because these are the average rates. And Odin, our team is pretty good at pushing and negotiating with the lenders on your behalf to get the best available rates in the market. And what's exciting is that although the rates seem to be quite high compared to some of the other markets, we're actually seeing some major banks and even non-major banks have started dropping the interest rates out of cycle. And what that means is that the market now sees that the rates have stabilized, and now it's a matter of when the rates will start dropping rather than if. So we're hoping to see the Australian government make some changes to interest rate in the near future. And now, as an expat living abroad, or for this audience living in the UK, what are some of the considerations and tips when you're looking to buy a property in Australia or looking to get a mortgage? So this chart just outlines how the property purchase price will be determined. So essentially, your purchase price will be determined by two levers. So one is your deposit, which could be your cash savings or liquid assets, or even existing equity from the existing property. And the second lever is your loan amount, which is driven by your borrowing capacity. So let me just take you through one by one and some considerations as an expat. So when it comes to deposit, So unlike first-time buyers in Australia, where you could potentially get a make a purchase with as low as 5% deposit. Typically, expats you do need minimum 20% of the purchase value, as well as the stamp duty and the government surcharges and the legal costs, which would account about another 5%. And by exceptions, we also work with some lenders who offer lending up to more than 80%, so that you could potentially make a purchase with 10% deposit, but it's by exception. And leveraging equity, it's also another powerful tool to support your borrowing position and deposit position. So what that means is that imagine you have a $1 million property and you only have $200,000 mortgage outstanding. That means that the $800,000, the difference, it's equity that's available in the property, and you could potentially increase your borrowing up to 80% of your property value. That means that up to $800,000, so that you could technically borrow another $600,000 on top of your existing $200,000, and you can use that $600,000 as a down payment or deposit for your next purchase. And that's of course subject to credit assessment and your borrowing capacity. And the other lever that I mentioned about loans, so that's purely driven by your borrowing power, which is taking your income, expenses, and liabilities into account. So as an expat, there are some pros and cons that you can consider. So for the audience here, so if you're on an employment package that's better than as if you're working in Australia, typically those higher gross income or even like allowance benefits for housing, educations, those would actually make a positive impact to your borrowing power. And also the stronger currency of the British pound versus Australian dollars, that would also make a positive impact to your borrowing power, as Australian lenders would consider your income converted into AUD. And then the other, I guess, the benefit is that by living overseas, it doesn't mean that you're penalized or you're getting a differentiated interest rates. You would still have access to the same interest rates and the product features as an Australian resident. However, when you're making a purchase, usually, unless you're imminently returning to Australia, you would typically disclose the property as an investment property. What that means is that you would get an investment home loan, which typically carries slightly higher interest rate than the owner-occupied home loan in Australia. However, if and when you return to Australia, you could always disclose to your bank that after you return and switch your product to make sure that you get the most out of your banks and the home loan. And there's one big downside that would apply to expats like us. So most lenders in Australia do apply so-called haircuts or restrictions to foreign currency income. So that restrictions could vary anywhere between 20 to 40%. So what that means is that let's say you're earning £100 every month. What the bank would do is that instead of taking the £100, the whole £100, that they would take either 60 or 80 of your income, and some aggressive ones would apply the Australian income tax rate, which is almost similar to the British tax rates. So from the $60 to $80 that you be the net income would actually come down to between like 40 to 50 pounds, which of course makes the number really don't stack up when it comes to calculating your loan amount. And that's where our team at Odin can come in to navigate you through which lender would offer preferred loan options, and what are some of the considerations and restrictions that you face. And you could access all those options through a single conversation. So if you would like to understand the numbers, or whether you'd like to get your pre-approval in place, just come and talk to us, and we're open to take you through how it all works. And I'll just finish off with just to take you through how our process works, and then pass over to my colleague Pau. So our process at Odin, it's fairly simple. So there are four main steps where it starts with assessment. So unlike some of the banks or mortgage brokers, so all of our experience is digital, where we don't collect any paperwork until we can give you some confidence on your borrowing options. So we collect your information verbally or through our online survey, and that would allow us to compare your information on our platform that talks to various banks and lenders, calculators, and policies, and so that we can narrow down your borrowing options from 20 plus lenders to say 3 to 4 the most feasible lenders that may suit your needs. And then once we get a firm decision from you, which lender that you'd like to go ahead for what loan amount, and that's where we start paperwork for you to review the list of the required information and then upload the documents through our portal, even just a screenshot on your photo, as simple as that. And then we complete your application, then get your application submitted. And until you, unless you have found a property, until you make a purchase, we typically issue you a pre-approval, which was valid typically up to 90 days of the approval date. And it's okay for you to not find the ideal property during that time, because we can help you extend or renew your pre-approval without the heavy load. And then once you once you make a purchase of the ideal property, that's where we'll issue a unconditional approval. That means that the bank has gone through the valuation, and your conveyancer solicitor would have conducted the due diligence on the contract, so that everything's ticked that we're ready to proceed with the settlement. And then during the settlement stage, the bank will issue you a loan contract where you can either digitally or physically review the loan documents and execute. And on the settlement date, typically it's the lender, your conveyancer and solicitor, and the vendor side would digitally meet together on the settlement exchange platform, and the property will be handed over to you. And just wanted to reinforce that, as I mentioned, that our service continue even after settlement. So our concierge function, where we monitor market every week, every month, where our job is to make sure that you access the best available home loan in the market. So we'll continue to review your home loan even after settlement, even when there's an opportunity for us to access better interest rates with your current lender. We'll help you negotiate. Or if there are other lender products that's available in the market, then we would help you potentially move or refinance to the better option, as long as it suits your needs. And as I mentioned, that our service will continue throughout the life cycle of the property. So until you sell down your property or pay down the loan, our team will be there to continue to support you. So if you'd like to know more about Australian property market, or getting a mortgage in Australia, or even comparing your current home loan, you can see the QR code here on the screen. So come and talk to us, and we'd love to help you. So on that note, I'll hand over to Pau to take us through some exciting implications in tax area. Over to you, Pau.
Right. Thank you, Stephen. So just a quick sentence. If you have any questions, feel free to drop on the Q&A section. Me and Stephen will come back at the end of the section, and we have received some upfront questions, so we'll answer all of them at the end of the webinar. So let me share my screen real quick. Can you see my screen?
Yeah.
Yeah, cool. So let me start with a quick introduction about myself, so everyone know where am I coming from and how can I assist you, and why we started with tax and mortgage at Odin at the beginning. So a quick background about myself. My name is Pau. I'm one of the partners at Odin. I look after the tax business at Odin. I came back from Sydney to Hong Kong. I'm now based in Hong Kong for 10 years now. So in the past decade, I've been pretty much doing the same thing, assisting all the Australian expats, foreign investors, or PRs who want to migrate to Australia to handle their tax remotely while staying as a non-resident for tax purpose, and to deal with the tax office in Australia. So we started tax and mortgage together because we think that's a combination. Not everyone would be looking at the property, but everyone would have a tax issue with the tax office. And most likely why a lot of expats still need to file a return in Australia is because of their property. They are still collecting rental income from their investment properties, so it doesn't need to submit a return to the tax office. So what we do at Odin, from a tax perspective, we assist our client to do from the simple stuff like helping you to submit your yearly tax return, make sure you're compliant, you are not late, you are making sure that ATO understand your situation as a non-resident for tax purpose. So your overseas income, UK income is not taxable in Australia, to a more high-level tax advice, including the strategy around property investments. Make sure you understand from day one in terms of the structure and what should you do, where should you invest, should you be using different strategies to minimize the tax payable in Australia. So maybe tax planning when you're thinking of repatriating back to Australia, what you need to be mindful of for any of your assets or income or savings that you have in the UK. So this is what we assist you. So very similar to a mortgage process, we value speed of the time that we get back to clients and also the advice that we provided to our clients. So why does it matter? It's very important because in the way that, like I mentioned before, few reasons. One is compliant. A lot of people thought that they have left Australia for many years, so it is no longer important to tell the tax office about the situation, and probably they don't have anything in Australia. But it is still important to stay compliant to update ATO that if you have been away, what is your situation in Australia? Do you still have any income from Australia? Because the most common issue I've seen is they left for many years, they have not been updating the tax office on their status. So in ATO record, they still have the client as a tax resident in Australia, meaning your income earning in the UK is also taxable in Australia because you have not been updating the tax office. And they don't know about your story. They could issue a penalty, which is up to 1,500, 1,565 per year because you are being late, even though you have no income. It's still a obligation to tell the tax office about your story, what happened to you. Another thing is make sure you understand as a non-resident what is taxable, what is not taxable. So um, simply whether it's any income you have in Australia will be taxable. Anything you make overseas is not. And also understand the cost of investing as a non-resident for tax purpose. If you're thinking of buying a property or other investments in Australia, what does it mean to you and what you need to do and whether that would affect anything for you in the UK. So if you have been filing returns, yes, stay up to date. We have due date coming in 2 days, 31st of October. So if you have not looking into your file, maybe it's a good chance that you want a good window that you want to start looking back and put more attention to your Australian tax. Make sure you are letting the ATO know about your story and you are being compliant. Again, this protect your UK income, so you don't need to report that to the Australian government. You don't need to pay tax in Australia for whatever you're making in the UK. Or another thing you can do if you foresee yourself to be not having any income in Australia, maybe it's a good chance or a good window to tell the tax office that you want to submit a final tax return, indicating to them that you do not foresee any income that you would generate from Australia in the future, and there's no requirement for you to submit any ongoing returns in Australia. So they will simply close your file with the tax office and they will not come back and bother you unless the point is situation has changed, you start to collect income from Australia, and then maybe you want to pick up at that stage. So the number one topic of what to do is always about tax residencies. I probably won't go too deep into how or what is a tax non-residence because that could take us a couple of hours to go into all the details. But a quick rule of thumb, if you are living overseas for good for multiple years and you have spent very limited time in Australia and your main focus of your life is overseas in the UK, it's quite safe to say you will be a non-resident for tax purpose. But again, everyone's situation could be different. So if you want to go deeper into your personal situation, you can always book a time with me and we can look into your personal details and make sure everything's done correctly, and you can be seen as a non-resident for tax purpose. So if you're non-resident for tax purpose, you would only be liable for any income that you are generating from Australia, which could be salary, which could be rental income, interest, dividend, capital gains, all of these income. So these will be an income you need to report. And even though you're only making $1 from Australia, you will still need to report a tax return and update the tax office, because one of the big difference between us living overseas as a non-resident compared to people in Australia is we do not get any threshold, tax-free threshold. We do not enjoy the first 18,200 as tax-free income. So we start to pay tax. Here's the table showing you the bracket. We start to pay tax on the first dollar. And from this year onwards, the rate has come down slightly from 30%. Before was 32.5. So, and the threshold has been widened as well. So for most people, if they are collecting income from Australia, they should be in the first level, the first bracket, 0 to 135K, unless you have a big capital gains event that may bring you to the 45% bracket. And for some people, if you still have a student loan hacks in Australia, we had a rule change back in 2017 that you are also required to report your overseas income to calculate how much you need to pay back on the hacks, on the repayment. So if you still have a student loan, you might want to look at either repay it in full, so you don't need to tell whatever you're making in the UK to the tax office, or you need to report to the Australian government on your earnings overseas. Again, this is only to calculate the repayment on the student loan. You don't need to pay tax on this income that you're making overseas. Um, so the topic, coming back to the properties. So it's important for you to understand the cost of buying a property in Australia if you're thinking of getting a finance and buying a property in Australia. So the rule of thumb is if you're an Australian citizen or PR living overseas, generally you'll be treated like normal people living in Australia. You would not be penalized just because you're living overseas as a non-resident for tax purpose, because when we comes back to the cost of buying, we're still looking at the citizenship. Are you a citizen of Australia, or are you holding a PR? The only thing I need to point out is if you're a PR living overseas and you want to buy in New South Wales, they are so far the only state that is not too friendly to PRs living overseas. They will still treat you like a foreigner. So there would be a stamp duty surcharge, which would apply to you. Be a PR looking to buy in New South Wales. So this is where our value comes in to advise you, make sure you understand all the costs given your different scenarios. If that's the case, you might want to look into other states to avoid that 8% surcharge. Or you might want to buy with your Australian partner or think of another structure to avoid that surcharge. Still, New South Wales, Sydney is where you want to purchase. There's another one called FIRB. Again, that's only applicable to foreign investor. So the full name is Foreign Investor Review Board application. If you're Australian or PR, you don't need to pay for this FIRB application. The fee, I think, is like 14,000 now if you want to buy a sub 1 million property. Another strategy you want to think of is a lot of people met their partner overseas, and or if you're a UK citizen, your partner is Australian partner. You might also want to look at the options of buying under your Australian partner's name, but you can come on board on the mortgage. That is another way to avoid any of these surcharge. If you want to put both in your name, who one of them may be a foreigner, we can also avoid from doing, again, a strategy on how to minimize these costs. So once you understand the cost, really just the stamp duty and the legal fee. Stamp duty roughly is about 5% across all states, maybe like some are 5.5 or more like 4.5. We always say 5% as a general number. So the next step would be maintaining the property once you have settled. And that's where you need to submit the yearly tax return to the tax office if you're collecting the rent from the property. And eventually, when you sell it, there will be the capital gains. You need to look at what sort of tax you need to pay in Australia. So about maintaining the property, a big important rule that still remain, which is the negative gearing. So it is still applied to non-residents for us living overseas. We can still enjoy the benefit of negative gearing. So what does it mean is you need to report your rental income from whatever you're getting from the property, but at the same time, the government allow you to claim a lot of expenses that you spend on the property to generate the rental income. So here I've listed out majority of them. There could be a few that is less common, but the rule of thumb is every dollar that you spend on the property to generate rental income is likely tax deductible, which includes agent fee if you're appointing someone to help you manage the property. So council rates, water rates, all of these government or local council expenses. The most important one, the interest you pay on the mortgage. Every dollar you pay on an investment home loan is tax deductible. The insurance, the body corp, any repairs and maintenance, land tax, depreciations, all of these can be added up to offset the rental income that you have from the property. So then it will create two scenarios. Are you on the upside or are you on the downside at the end of the year? So if you are making a positive income still from the property, then obviously you would then refer back to the table I showed you before on which level are you on, what tax you pay, likely again the 30% mark. But if you're in a loss position, you're making a loss after deducting all these expenses and depreciations. We call that a tax loss, and you can accumulate and carry forward this tax loss every year. If you're making 10,000 this year, 8,000 next year, it will just simply get added up to the future to the point that either you start to collect when you move back to Australia, you start to working again, you can use to offset the employment income, or when the property becomes positive because you pay down your mortgage, or when you sell the property, you see a capital gains. Any of these accumulated tax losses can be used to offset the income, whatever comes in first. So at that stage, you may still not need to pay any tax, or you're going to pay a much lower tax because of the negative gearing. Finally, in terms of the sales of property, you would need to pay a capital gains because if this is an investment property, you would have a CGT element. So when you sell the property, again, we simply look at do you make a capital gain or do you have a capital loss? Anything, rule of thumb, again, anything related to the purchase and sales of property is likely to be deductible when we are doing the CGT calculations. I've listed out the most common items here again. The stamp duty, the buy agent's fee if you're using a buy agent to help you source the property, legal fee on purchase and sales, agent's commission on helping you to sell the property, some of the marketing expenses like advertising, staging, uh, furnishing the property, those can also be deducted from the capital gains. And then at the end, whatever losses that you have accumulated from previous years can now be used to offset the capital gains. We then look at deducting after all these expenses, what is the capital gains that you still have and simply pay tax on it. A big thing to note when it comes to capital gains for expats, for non-residents, is we had a rule change back in 2012. So after 2012, as a non-resident for tax purpose, we do not enjoy the 50% discount. Still, people in Australia, as a tax resident, they can enjoy it, but we living overseas, we don't. If there's a chance that you're going to go back to Australia in the future, you would be able to pick it up from that time onwards. But what happened in the past could not be changed. Even if you have been living away for 10 years, for the 10 years as a non-resident, you would not get any of the discount. But when you go back to another 10 years, for the later 10 years when you're in Australia, you would be able to have or enjoy that 50% discount. Because at the end, what we do is pro rata calculations, looking at your tax residency every year and see what sort of discount that you can get. Last thing about a discount. So, sorry, this 12.5% withholding system. So if you are in the future looking to sell the property and you are selling for $750,000, you might go into a withholding system, which simply is ATO want to, because you're living overseas, they want to take some money as your projected capital gains tax at settlement, which is a 12.5 of your sales price. They want to take that and keep in within the tax office until to the point you show them your calculation on how much you need to pay. Either you get a refund or you pay the difference. So if in the future, if you're selling for 750, be mindful this 12.5% withholding system will kick in as a non-resident taxpayer. And what we can do as a non-resident is for people in Australia, they can have another way, which is they can get a clearance certificate, simply meaning ATO understand they're in Australia. If anything happens, it is much easier for the ATO to find them locally and try to collect back the money. But for us, we're living overseas, we can only do a variation to change from a 12.5 withholding to a lower percentage if your eventual capital gains will be much lower. This will require you to be like up to date on your tax return. Your record is all up to date. So it's important, again, make sure you complete your return. If you have losses, that's where you can then apply to offset the capital gains. So that's simply a quick snapshot about holding a property, what is important to understand from day one of buying a property to holding to eventually when you sell, what is the return or the capital gains you need to be mindful of. And lastly, I wanted to just quickly mention about one of the services that we offer right now because of the due date is approaching in a few days, 31st October. At Odin, we do a free health check, especially for those expats who has left for many years and they have not really cared too much about the tax in Australia. So what we can help in with this health check is we can simply add you into the our taxation portal, and we can help you look into your history with the tax office to see whether you have many years of outstanding returns or you are kind of up to date. And if you're late, we can then help you to look into what information the tax office has and to provide you with an action plan, what you should do next. Again, I would suggest if you've been late, you might want to look into this as soon as possible to avoid any of the late submission penalty and also catch up, make sure your UK income is not taxable. So we'll send you a link later. If anyone is interested, maybe you can just help me complete this form. Our team will get back to you and we can later arrange a meeting to go over your personal stuff. So I would pass back to Stephen for now, and we can then go over some of the Q&A questions to answer everyone's questions.
Yeah, fantastic. Thanks, Pau. And yeah, thanks so much for a lot of insights when it comes to tax in Australia. And just to reiterate, yeah, so the tax return due date is not so far away, very close, in fact. So we're offering this free ATO health check, which I don't think many accountants would actually offer. So please come and talk to us, and it's complimentary. So we won't charge you for the conversation that we're going to have. So now let's move on to some of the questions that we have been receiving through the chat and also the registration. We'll go through as many questions as you can, and just by looking at the question, I can tell that it's a tax season, Pau, that you're very popular. So maybe let's start with the first one for you. So I'll just read out the question. So the question is, with the CGT calculation, can you confirm that all the negative gearing losses can be used to reduce the capital gain upon sales?
Yeah. So again, any of the losses that you have accumulated from the property throughout the ownership can be used to offset the capital gains. So, and this is one of the strategy a lot of expats are using is by throughout the years, while they spend the time overseas, they can stack up a portfolio, maybe like 2, 3 properties, and eventually all of these property can be accumulating some losses. When they sell property one, the one they bought in the beginning, that's where they can then use the losses, accumulated losses to offset any of the potential capital gains on property one. And that could be a world that you pay no capital gains at all because of these losses. So it is still possible.
That's awesome. Thanks, Mel. And I'm just going through some of the other questions. So another question is that does any state or territory tax unrealized capital gains on the property investments?
No, so still, when it comes to capital gains, there's only one scenario that maybe unrealized capital gain will be taxable, but in general, for properties, you don't need to pay anything, and there's no inheritance tax in Australia. So at the end is when you actually sell your property in Australia, that's where the capital gains will kick in. The only time that unrealized capital gains would happen is if you have Australian shares. If you have Australian shares, there's a method you can use to offset or minimize the potential capital gains, which you call a dim disposal, to deem that you have sold these shares at the time when you left Australia and to wrap up the tax. Because for shares in Australia, they are not taxable like properties. So you don't pay any capital gains on shares. So it's only that the element may be different. But when it comes to property, it's always at the end of the day when you sell the property.
Fantastic. That's awesome, Pat. And I've just got a mortgage question on which I did address in my session, but I'll just unpack a bit more. So the question is how to extract equity and reinvest as an expat. So as I mentioned, that you can actually use the equity in the existing property as either a deposit or 100% of the purchase costs for your next purchase if the numbers work out. So it's driven by how much equity that you have available in your existing property, as well as how much borrowing capacity that you would have in the existing property. So going back to that example that I outlined, for the $1 million property with a $200,000 mortgage, by the fact that you have $800,000 mortgage, it does mean that you can access that $800,000. So firstly, that you can increase the borrowing up to 80% of the purchase price, sorry, property value, so that the remaining the equity value is $600,000. However, you also need to show that you have borrowing capacity to borrow another $600,000, which will be driven by your income, expenses, and liabilities. So that's where I would strongly encourage you to speak to one of our specialists at Odin, that we can actually take you through the options on accessing equity and how much you'll be able to access with which lender options. And then another tax question, and for you, Pal. So actually, I've got two for you. So one is it could actually apply to some of the new expats who are just moving. So question is, how how do you know your tax residency status when you move to the UK in the middle of the financial year?
So the rule of thumb that we use in Australia is we look at intentions. If you are leaving, where do you live doesn't really matter too much. It's more about if you're thinking of leaving Australia and residing overseas for good, that's where I would say your intention change. You want to be a non-resident for tax purpose, and that's where I call a cutoff. So after this dates, whatever you're making overseas has nothing to do with Australia. You don't need to report any income you earn in the UK after this dates. So yeah, simply is where do you see your intention change?
Right, awesome. And the other question is, can you elaborate a bit more around the double taxing between Australia and UK? So, for example, if we were to bring money from Australia to the UK or vice versa, what would be the tax implications?
Yeah. So again, I'm not an expert in UK tax, but I do know a little bit. But I do know about the DTA between the two countries. So the rule of thumb why we have a DTA is a double tax agreement is to protect people paying the same amount of tax, same amount of income twice in the two jurisdictions. So if you are thinking of bringing money from one to the other, as long as you can show that's a saving, that's no longer income, generally there's no tax involved. But there could be a world that this is considered as an income, then you need to pay tax on the other countries. And what it does is the DTA will protect is um, you can also include the tax credit that you pay. For example, you pay in the UK, and you can use the credit as a foreign tax credit in your Australian tax return. So simply, you won't be taxed twice on the amounts. What we are looking at is just the difference. For example, UK tax you at 30% and Australia tax you at 32.5% on the same amount of income. you already pay the 30% in the UK. In Australia, you only need to pay the 2.5 to make up the difference. So it would avoid the issue of paying the same amount twice, which can go up to like 60%.
Great, awesome. So thanks for the clarification. And I think we've got a couple of live questions, and then I think the last one is like could be a bit of a discussion between you and me. So let's knock this off. So strata fees for strata properties, could those be tax offset?
Yeah. So strata simply as a body cop. So that is
Yeah.
also expenses that you can claim on a yearly tax return because again, you pay them to generate or to rent out your properties. So it can be offset against the rental income.
Mm. Yeah, cool, awesome. Um, yeah, so I think this question, this and we'll probably just make it as the last question and then wrap up. And I'd love to get your view, Pau, and I've got my own view as well. So as an expat, like, is it worth buying something now and rent it out, or wait for another 12 months, even after even I'm as an expat, I'm planning to move back to Australia in 5 years. What's your view? Should we buy now or wait until what happens?
Yeah. So from a tax perspective, um, being honest, there's no additional benefit of being an expat of buying a property now compared to people in Australia. Like I mentioned, we as an expat, we still lose that 50% discount on capital gains. So from a tax perspective, you are not better off of buying earlier than later. But I guess the question is more about, what would the market look like if in 12 months compared to now and later? Would that 50% for 1 month be worth on the 5-10% of increase in Australia in terms of the market? And whether this is going to be an investment or this is going to be your future home. Because if this is somehow to be a future home, again, you would still enjoy the main residence exemptions once you move back and live into the property. So when you look at a 10, 20 years ownership of this property, it probably wouldn't matter too much for that 1 year that you were still living as an expat, that you don't enjoy any of the CGT discount. But I think most important is how the market is performing, especially now with the rate starting to drop. That might trigger another boom. I don't know. That might be your questions. You're more capable of answering the questions.
Yeah, thanks, thanks, Pau. So yeah, so my view is it's probably leaning on a lot of case studies that we had on many clients at Odin that we serve. So um, it, as an expat, if you have a future plan to return to Australia, whether it's next year or in 5 years, um, we ask our clients to take a look at the numbers. So just going back to the recent charts that I was sharing, that many of our clients actually have waited to see the market to come down. And what they realize is that the pace of the growth of the market or the property value, it actually required a lot of those clients to actually save up more to increase the deposit amounts. So a lot of the banks and lenders have sort of put screws on to like 10% deposit, where most lenders now allow 80%. And what we do encourage to our client is that, look, if there's another vehicle or assets that you think that you could earn 7%, 12% on a consistent matter, and you think that you'll be able to outpace the growth of the Australian property market to come up with higher deposit with lower effort, then that's the client's decision. However, if you have an intention to return to Australia and looking to buy a property whether now or later, we would strongly encourage you to look at the property market now and then work out the numbers with us now so that you know how much deposit that you need to prepare to find the purchase in the areas or the regions that you like, and also the type of properties that you like, and also how much borrowing capacity and what borrowing options that you would have. So that way, at least so you know the range of numbers to plan out. And a lot of our clients typically, as an expat, that unfortunately, because we're not on the ground like every day, that's why many of our clients choose professional services like buyers agents. where you're going to compete with onshore Australian buyers as well. So typically, our expat clients turnaround time to make a purchase is slightly longer than the onshore buyers. So if you're planning, I would suggest to start exploring and talking now, and it's never so late. So yeah, come and talk to us. So well, on that note, so let's wrap up, and thanks so much for everyone for your time. And this webinar is recorded, and we'll be in touch with those who have registered for the webinar to see if they have any questions or whether there are any particular areas that we might be able to help out. But again, if you have any other questions, just reach out to us. And thanks for your time. Enjoy today. Take care.
All right. Thank you, Stephen. Thank you,
Thanks,
guys.
bro.
Yeah. Bye.